Chapter 12, Your Grand Exit, Dying or Selling. Some long for the glories of this world, and some sigh for the prophet's paradise to come. I'll take the cash and let the promise go. Omar Khayyam said that in the Rubaiyat. The CEO world is largely populated with careful, comfortable founders and owners who were once bold and courageous entrepreneurs. No matter where you live, they're familiar names. Business leaders who speak to the Rotary Club and head up the United Way Drive. They run a mid-sized CPA firm or a lumber company, a car dealership, an ad agency, or a manufacturing plant. They are all perceived and respected as pillars of the community. At one point in their lives, they snatched control of their destinies, stacked all the chips they had on the table, and created or acquired a business of their own. They took a ballsy chance and succeeded. Then, recoiling from the shock of their own unexpected success, they decided that their one big score was a lucky break, a fluke, and they could never repeat it. So they took up a safe defensive posture to protect what they had miraculously achieved. They dug in and frittered away the rest of their career, trying not to lose what they had achieved. Today, years or even decades later, they're still dug in, basking in the respectable mediocrity. Their names are on the letterhead, their portraits are in the lobby, and their stupid sons are in the vice president's offices down the hall waiting for them to die. I've come out of retirement again and committed myself to saving as many energetic, determined entrepreneurs as I can from the fate I've just described. If I kick you around and hold your attention long enough to inspire your first quantum leap, I'll be damned if I'm going to let you do it once, then quiver behind your desk for the rest of your career. The truly successful high performer understands that the strategies and skills which he marshaled to generate the first quantum leap can be called upon to repeat that success over and over. That's why he doesn't hang on his first venture like some sort of corporate teddy bear. He's secure enough in all his abilities to build it up, then sell it off for a bundle and start the process over again. You as a progressing or even entry-level entrepreneur can make a quantum leap, hold on to your company, and sit on your assets the rest of your life. Or you can keep your dream humming along for a few years, improve its profitability, then dress it up and unload it for a substantial profit. Succinctly put, unless you're thrown out by your own shareholders, you have two exit strategies options: die or sell. Author's note: having been thrown out of more than one company myself as a founder, I relate to this section extremely well. End of author's note. I can't help you prepare for the first option. Fortunately, I've never used that strategy nor taught anyone who did. I'm far more familiar with the latter, selling, and I can give you some pointers on how to puff up the hog ready for the fair and get it ready to bring you top dollar. Owners sell their companies for several reasons. Some are simply ready to retire, take the cash and enjoy a more leisurely life. Others want an injection of capital to continue to grow their company, or an affiliation with a larger company with greater distribution, marketing, and manufacturing resources. The best reason I can think of to sell a company is to free up assets and turn equity into cash, lots of cash. Selling is the natural end of a cycle that began when you decided years ago to begin or acquire your first company and make your quantum leap. If you're young and energetic enough, and most of us are, you can take part of your newly liquefied asset or the leverage it provides and acquire a second or even a third company and start the process over again. One thing I learned quickly: making an enormous amount of money suddenly from a single transaction is habit forming, absolutely erotic. And you're 18 again and you can't get enough. The more you do it, the more you want to. Author's note: having just had my 72nd birthday and working with approximately 100 mentees yearly, which are a result of my 4 to 6 seminars a year, I can tell you that the kids, once they've tasted the quantum leap, can't get enough. End of author's note. Pay yourself first. Before we get into the specifics of implementing your exit strategy, let's talk about paying yourself and your people. A company owner whose aim is to grow the company arithmetically will characteristically plow profits back into the company to strengthen its financial profile, to purchase new equipment or expand however necessary. I can't emphasize enough that you, as a company owner, need to pull money out of the company to pay yourself so you can begin to enjoy the lifestyle that you and your family have earned. Many owners feel guilty about rewarding themselves, as if they're betraying the company. The mentality is fine if you never intend to sell, but if you plan to sell, as I hope you do, you'll feel less obligated to squeeze every penny out of the deal if you've been paying yourself all along. While you are paying people, never forget the employees who have made your company successful enough to become a marketable item. Your employees may love you for your charismatic leadership, but trust me, they're in it for the money. If they do everything you tell them to, everything they feel is expected of them, they don't care if the business is temporarily lousy, they expect you to reciprocate. They need a bonus now and then, especially at Christmas or end of year, which confirms their value to the company. So take money out and put it aside for you and your employees so you can pay several deserved bonuses in all business conditions and cycles. When you borrow money, borrow enough to tuck away for the employees' bonuses. Don't make yourself wait, and don't make your people wait for the rewards they deserve. The cliche is true. Take care of your people and they will take care of you. How much is the company worth? The market, not you, will determine how much you will ultimately get for your company. The fair market value is what your company or any commodity can bring in open exchange between a buyer and a seller in an uncontrolled market environment. You should bring in professionals to perform valuations so you have at least a ballpark estimate of how much to ask. Be assured that any serious buyer will conduct his own valuations because nobody believes projections or even current figures provided by the seller. Buyers make their decision based on what they think the projections are after examining your records for the 3 years back. Regardless of who does it, there are 4 universally accepted means of valuing a company, plus one which is all too often used by the business owners. Number 1, the asset approach based on fair market values. This method adds up the fair market values of the company's assets after netting out the total of the firm's tangible liabilities. A real estate holding company might use this approach. Quite often, a company in financial trouble will do an asset-based valuation just before going out of business, liquidation sale. This type of valuation would be appropriate for an outside manufacturer plant sitting on a valuable piece of property. Number 2, the income capitalization approach. This valuation method, also called discounted value of future cash flows, is based on the current worth of economic benefit that will be enjoyed by the buyer in the future. It tracks the company's expected future earnings stream over a predetermined payback period, expressed in the percent values dollars. This method is filled with iffies because who can predict interest rates, inflation, or hypothetical future revenues and expenses? Nevertheless, most prospective buyers want to use this approach to assess your company's value since it stresses future performance. Buyers will typically pay 3 to 5 times annual cash flow, all other factors being equal. Accordingly, if you use the same type of valuation, you get a clear idea in advance of how much a prospect may be willing to pay. Number 3, the market comparison approach. This method is similar to that used in the real estate market, comparing the financial performance and ratios of similar companies, i.e., return on assets, debt-to-equity ratios, return on sales ratios, return on equity, and price and earnings PE. Average industry ratios are published by Dun & Bradstreet and by the U.S. Bureau of Census in their quarterly financial report for marketing, mining, and trade corporations. The PE ratio is perhaps the most widely used measure of comparison since it provides the most accurate reflection of a company's earnings power and growth possibilities. It expresses a company's value as a multiple of net earnings after taxes. The higher the key ratio, the higher is the firm's growth potential. And number 4, the gross revenues approach. This method is for companies like the ones I like to run, the gush torrents of income and matching expenses with few, if any, retained earnings. In most cases, they have a few assets and a little capital investment. Examples of these are consulting firms, retail companies, radio stations, employment agencies, dealerships, professional service businesses, and public relations and advertising agencies. A specific company's value is expressed as a multiple of annual gross revenues. The multiple is based on such factors as the company's reputation, time in business, sales record, and the strength of the industries. Multiples are very subjective and are based as much on educated guesswork as industry figures. This is the best way to value a company, which is referred to as a cash cow, a company which only requires the buyer to survive and keep quiet to make money on his investment. Number 5, the here's how much I want, take it or leave it approach. Some business owners, especially those who have developed a deep emotional attachment to their company over the years or who have specific cash needs, will begin their valuation not from the worth of their company, but from the amount of money they want or need out of the company. Unfortunately for them, companies are valued on their respective strengths and weaknesses, not on the personal desires or agendas of the owner. Puffing up the hog to take it to the fair. Puffing the show hog is no ideal phrase, as any former 4-H kid will tell you. When your prize porker is going to be judged by the pound and the round of its figure, you make sure that before the two of you head up to the fairgrounds, the fat sucker is fed to the snout with its favorite corn. What better scrap of Americana could I apply to your taking your own prize company to market? Timing. Search for a perfect wave. As you will have learned after you've been in business for a while, you compete in a cyclical economy and a cyclical industry. It grows without saying that you want to sell your business in a strong market. The problem is that there are several indicators you need to read and consider before putting your company on the block. The ups and downs of the economy sweep over your company like waves, influenced by interest rates and periods of stable and general confidence in business. Concurrently, your specific industry may be in the upswing or the downswing. The mid-90s, for example, saw such industries as computer technology, communication, and healthcare sweep like tidal waves into the hearts of investors. Others, which cater for fairly stable wants and needs, hardly feel the bumps and dips. Add to these variables the condition of your own company and its profit picture over the past 3 years. You're hardly in the position to demand top dollar if your revenues over the past few years have been flaccid. Achieve at least 3 years of solid profit. Make it jump out of your books to grab the attention of the most casual reader. You're likely never to ride the crest of all 3 of these waves in the same time. Nevertheless, you need to monitor them. The economy, the industry, your company, so that you can at least aim for the seller's market when you decide to sell. If your overall plan calls for you to sell in 5 to 10 years, you'll track through several cycles of change before you finally sell. As a rule of thumb, however, I tell owners that if you're over 40 years of age, to sell during the next upcycle and get the hell out. Author's note. As I said in November of 2016, when President Trump won the election in the United States, we were going to see the greatest transformation of wealth in the world since World War II. Now, in end of September 2017, we've seen about $4 trillion added to the U.S. stock markets alone, and thousands of jobs and many industries growing again in the United States. I believe, or I know, that we only just begun to see the effects of the Trump presidency with all its hazards. End of author's note. A clean house brings a higher price. The snapshot of your company on any given day, its financials, its contracts, even its physical condition, is not the picture you want to present to the potential buyers. When a potential buyer strolls through your premises, the most insignificant images stick in the mind. The receptionist greeting, the clutter in the stockroom, the dirty carpets, the crowd in the lounge, the wards on the walls, the demeanor and the noise level of the employees. Remember, whether a person is buying a car, a house, or a business, much of the decision is emotionally based. Above and beyond the financials, buyers feel whether a company is right or not, just as you, the seller, can feel whether a buyer is the kind of individual or conglomerate you want to sell your hard-earned company to. Prior to trying to sell your pride and joy, paint and repair as needed. Clear corridors, storage areas of accumulated files and boxes. Replace outmodel equipment. Repave the parking lot, if necessary, and redecorate your offices to reflect an efficient, productive, yet warmly human environment. This is called puffery. Now, shoring up your organizational structure. Housekeeping at the most elementary level requires that you update or create salary guidelines, board meeting minutes, job descriptions. In fact, even the smallest company needs a policy and procedures manual for employees covering hours, vacations, health, insurance, retirement plans, and record-keeping procedures. An organizational chart complete with the titles and lines of accountability will convey a sense of organization and suggest that you as a CEO are already grooming others for senior executive positions. A credible board of directors. Another preparatory step is one we've discussed relating to establishing your company in the financial community, that of assembling a distinguished board of directors. In some part of the world, these are called advisory boards. Just as a list of respected executives on your board impresses a banker, it also speaks volumes of the potential buyers. Recruit them carefully, person by person, as if it were putting together a team of all-stars. Offer them free stock or options and warrants to compensate them for the use of their name and the time they may spend advising you and your successor. Far beyond window dressing, in fact, your board can provide you and your potential buyer with a wealth of business acumen and wisdom well worth purchasing. And remember, as I say in my seminars, I bought my first Dream Team board of directors. Author's note. By that, I mean on the New Year's Eve of, I believe, 82 or 3, I got a call from a wealth person that I was in business with to buy a company from him on a fax machine overnight for tax reasons. And I did. And with that company came a very distinguished board, including the founder of the North Sea, Robert Dyke, who was nicknamed Dry Hole Dyke for his 88 dry holes and the 89th well that he drilled and brought in the Argyle field, which arguably saved Great Britain from bankruptcy under Mrs. Thatcher's administration. End of author's note. Corporate literature. The company also needs some literature to add to its legitimacy. A brochure tells prospective buyers, as well as clients, of course, that the company is prosperous and aggressive in its marketing program. Brochures for high-tech firms are especially effective in explaining the company does in pedestrian language. An illustrated color brochure will add pizzazz to the company's seemingly mundane and complex businesses. Author's note. And today, 2017, in addition to the brochure and sometimes replacing the brochure, would be a corporate website which puts your face in front of not just the prospective buyer, but the rest of the world, because we are so electronically connected now. End of author's note. Clean financials. Clean up your financials too. I'm sure you wouldn't do this, but a lot of companies use tax avoidance strategies, such as excessive compensation, to camouflage earnings from the tax authorities. Such tactics may well have a negative impact on a potential buyer who says to himself, what else are these guys hiding? But beyond ethical issues, buyers will typically only recognize your taxable profits. You're not going to pay for earnings that are invisible or not clearly documented, no matter how blatantly you nudge and wink. In order to avoid getting caught between the tax authorities and the concerns of a potential buyer, I suggest that in anticipation of putting your company on the market, that you invest in taxes for a couple of years. Yeah, when all else fails, pay your taxes. Just keep in mind that your company will be acquired based on multiples of earnings, so your investment in 1 or 2 years of taxes should bring your multiples of that amount when you sell. We've talked about audited financials. Such a report issued under the logo of a respected accounting firm will lend credibility to your company. This is another reason to get honest on your tax avoidance schemes, since a reputable national CPA firm will tisk you for those practices. As you recall, these eye-shadowed bean counters are really trained to work for the tax man and against you unless you can convince them otherwise. Author's note. Europe, or especially the UK, they're not called CPA firms, they're called chartered accountant firms. End of author's note. During the normal course of business, you may have gotten a little loose in collecting your receivables and tightening up your inventory. Uncollected receivables that you'll never collect should be marked down, as should those dated and cobwebbed items in inventory that you'll never sell. Sure as hell, a prospective buyer will dispatch his auditor to find these untidy holdovers. So you find them first and write them off. None of my companies will ever enter into an acquisition audit by a Big Four firm. Author's note. If the acquisitions, as I tell the mentees now, currently in the 21st century, are small, $1 or $2 million, or 1 or 2 million euros or pounds, rather than forego a expense of a full-blown audit, your CFO, finance director, your industry expert, and your CEO should be able to do a preliminary audit enough to purchase the firm or the company. End of author's note. Stable long-term contracts. Another cleanup chore is to strengthen and lengthen contractual agreements. Any potential purchaser wants to buy into the same pattern of arrangements which have helped make you successful. These arrangements include any property, equipment leasing contracts, and in a union environment, any labor contracts. If you're anticipating selling, negotiating ahead of time a long-term labor contract that subsequently gives any buyer a sense of stability with regard to his union workers. Although this isn't always possible, it is definitely worth trying. Customer contracts are equally important. When we were negotiating to purchase Bow Valley USA, we looked carefully at the extensive coal contracts and the company had with utility companies all over North America. Those contracts were part of the firm's assets as surely as were its coal mines. Also solidify any contracts you have with suppliers to provide you with the raw materials or other products at a certain price for a number of years. The more contracts you will nail down with every party, the more stability your craft into promising deal for a likely buyer. Cleaning up your paperwork. If you're like most owners of private companies operating outside the public spotlight of the SEC disciplines, you've got a hell of a lot more to do than clean, timely records, like run the damn company. That's fine if you never intend to sell. Otherwise, it's in your best interest to maintain all the data a prospective buyer looks for as evidence of organized and efficiently run operation. For example, payroll records, tax records reflecting up-to-date filings, documentation of any bank loans, documentation of copyrights, trademarks, or patents, copies of current licensing, distribution, or franchise agreements, all documentation required by OSHA or EPA and other bureaucratic tentacles of government. Speaking of the Environmental Protection Agency, make sure your company is in compliance with any appropriate environmental regulations and guidelines. Hire an outside evaluator to check your procedures and processes for dealing with handling and disposal of any waste your company may be generating and documenting everything. Information and financial control systems. Buyers who see a working system of controls in place are more likely to pay a premium for the company. They know that your systems will save them the agony of having to install these processes at a time they're going through post-acquisition transition. I suggest you have your accountants or an external consultant review your controls and data processing systems to ensure they meet your needs. The cost of these reviews will be more than recouped in the price paid by a satisfied buyer. The transition management team. Buyers want assurance that you're not going to hand them the key at the closing and disappear, along with the expertise which has made your company successful. You may now be running your company single-handedly, but if you're planning to sell, you'd better begin to develop a management team, a second level of competent management, and a control which will ultimately make you dispensable and raise your buyer's comfort level about the people he is inheriting. Especially key to this management team is a conscientious, certified chief financial officer who continuously feeds data into the system. In addition, almost any buyer will want you personally to be around during the transitional period, leading him through the processes you know by heart and helping him establish relationships of his own with employees, customers, suppliers, bankers, and anyone else in the business community who can continue to provide him support. Depending on the size and the complexity of the company and the confidence and experience of the purchaser, you might be asked to stick around for anywhere from 90 days to 2 or 3 years. Negotiate the shortest period in your buyer's comfort zone. You want to get on with your life and begin your next quantum leap. Besides, former owners, becoming increasingly irrelevant to all parties, tend to take on aura of a ghost from the past if they hang around too long. Lawsuits in progress. While you're tidying up, cleaning up your lawsuits, if you're a defendant, settle wherever possible and put litigation behind you. On the other hand, if you're a plaintiff, keep the suit. Make sure you advise the buyer of the particulars of the suit and emphasize why you feel it's important to pursue it to the end. The buyer will appreciate your being forthright, and you give him the option to continue or drop the action after purchase. Structuring your deal. The financial and legal form your company sales takes depends on your liquidity objectives, tax strategies, and other goals, which may or may not be a conflict with those of the buyers. The structure that emerges from the acquisition negotiations is typically a compromise of what you need and what the buyer wants. There are 4 basic ways you can structure the sale of your business. 1, the purchase of your corporate stock, cash and or other consideration, and you pay taxes on the purchase price. 2, the acquisition of your stock in a tax-free exchange of stock. 3, the taxable purchase of all the portions of corporate assets for cash and or other consideration. 4, the acquisition of all or part of your assets in a tax-free exchange for stock. The S Corporation. With regard to taxes in the U.S., if you're at the stage of founding or purchasing the company, talk to your accountant about establishing it at the outset as an S Corporation. This is a vehicle that has been popular with qualifying companies since the Tax Reform Act of 1986. It gives companies a protection and structure of a corporation, but a tax treatment as a partnership. The S Corporation sells assets, passes the gains or losses to individual shareholders who are then taxed at their individual tax rates. There are no corporate taxes. The law stipulates that to qualify as an S Corporation, your firm must have only individuals as shareholders, not investment groups. For example, only one kind of stock and no more than 35 shareholders before you think about converting your existing company to an S Corp. Bear in mind that the IRS says you can't sell or liquidate within 10 years of your company conversion. So if so, you'll be taxed like a regular corporation. Author's note, we are not giving you tax guidance. You should consider any advice of your own personal tax advisor. And if the law has changed reference S corporations, I'm not qualified to say. End of author's note. In summary, the time to begin thinking about your exit strategy is at the beginning of your entrepreneurial experience. From the first day you open your doors, keep full records and documentation, maintain written policies and procedures, and regardless of how much of a pain it is, operate as if you were planning to sell in 3 months. Watch and learn to anticipate economic and industry trends and cycles. Keep an eye on the companies comparable to yours are selling for. The whole time you're in business, you'll be preparing to exit on your terms. And should a buyer happen to appear in your lobby unexpectedly some morning, you won't have to scramble around at a disadvantage that could cost you hundreds of thousands, maybe millions in purchase price. Finally, whether you're just starting out or you're already in business, think of your dream company as a stepping stone, not as the end product of your dreaming. You can grow and nurture it, but never develop such an attachment that you cannot bear to sell it someday, regardless of your best interest. High performers regard companies as a means to the greater end, that being enormous wealth and total independence to pursue further goals in life. Your quantum leap will have already propelled you further than most dare to dream and put you at the starting mark of a lifetime of quantum leaps. Author's note, as I tell the seminar attendees at the Castle, that when you start your company, you start with a dream, but it's in preparation for a sale. The only person that does not look for that end sale is if you are building a legacy business to turn over to your family, which we do have some from time to time. End of author's note.